Hello, MAC 504 students. This is Professor Hazera. And as I told you in my email a few days ago, the way we're going to handle this, at least initially, is um, I'm going to use four or five recordings to show you how to make full pro forma valuations of different company stocks. Now, these are just general models as we've done in class. And the results you get may or may not be valid, but I believe that as time goes on here and the stock market keeps going down, this is Friday the 13th. What a day. This is Friday the 13th, but as the stock market keeps going down, there may be some value plays out there if you just wait a little bit. So the stock we're going to be looking at is one that you should be familiar with, and that's Applied Materials. Now, and that's the reason you should be familiar with it is because you had a quiz on it, and I have already graded the quiz, and I'll get it back to you somehow. But anyway, so this is Applied Materials, and you're looking at the 10K for Applied Materials, okay, and this company was presented by one group. Now, in this first video, this is actually a review. In this first video, I'm going to go back over how to do the short form valuation that we did in class. It doesn't have full pro financial statements. It's not very fancy, but the concepts are all the same. That's why I'm going to go back over this. And then for the next 4 videos after this, we're going to take this particular worksheet, and then we're just going to keep adding to it little by little until we finally come out with a full pro forma valuation. Okay, now this is the 10K of Applied Materials. One of the groups presented in class. I believe it was the group of 2 who did a fabulous job for this company. Now let's just take a quick look at the company's financial statements here. Okay, not a terribly large company compared to some of the others. I think we saw Apple had $270 billion of revenue, and Applied Materials has $14 billion, about $14 to $16 billion in revenue. So it's not a terribly large company. Anyway, this is their statement of operations, i.e., that means their income statement. Their net income was $2.7 billion, and their basic shares were 937 million, and their basic earnings per share is $2.89. So this is the income statement, and we're going to be using, when we get to that, I'm going to talk for a few more minutes. We're going to be using the number income from operations to start our free cash flow calculation. I'm changing it just a bit from the way I did in class, just to I'm going to start tweaking things as we go along here. Anyway, so that's their statement of operations. Let's just go a little bit to the right here. Get their balance sheet. Now you see that they have total assets of about 20 billion, of which 3.4 billion are in goodwill. So they've done some acquisitions, but this company is tiny compared to Apple. This could be a fraction of some small division of Apple. So there's might be room to grow here, although I don't remember it as a huge growth company. Now, just to the right of that, of the consolidated balance sheets, are the ratios, and those are actually the answers that I came up with the quiz you did in class, and I've graded, but we'll get it back to you somehow. And way out here, if you move out about 6 worksheets here, one of the most important statements that we're going to be using to do our valuation is the consolidated statements of cash flows, and that's why I reviewed the statement of cash flows in class, and a lot of the free cash flow information, the basic information, is going to come from right here. Okay, so to just start, let's go back to the worksheet that says ratios. Okay, and what I'd like to do, and so we're starting to build a full valuation, and of course, the first thing you want to do is calculate the ratios. So, but what I want to do now is I want to do a very brief calculation like the one we did in class and like the one the group presented. Okay, so what we're going to do here is I'm going to try to go through this slowly, unlike I do in class. I'm going to try to not to mention my bowling scores, the 200 I've been getting lately, unlike I do in class. And what we're going to do here is I'm going to insert a sheet. Let's start by inserting a sheet here. Okay, and we're going to insert a full worksheet here. So you know how to insert a worksheet. You double click on the ratios tab there, and then you insert the worksheet here. And let's change, first of all, let's put it to the right of the ratios. I like this. I like the ratios to be first, then the small calculation, then the big pro forma calculation. So let's go ahead and I'm just going to just make sure to insert the worksheet. I put it in the wrong place. I would rather have it to the right of the ratio sheet. So there it is. And let's go ahead and just rename this worksheet basic valuation. And that's different from the full pro forma valuation, which we will put to the right of this basic valuation here, and which will be a lot more detailed, and there's a lot more theory that goes into that. And if you do it right, you can do a lot more what if type analysis with that. Anyway, so this is a review of what we've done in class, the two-stage valuation. We're going to do a two-stage valuation. And if you remember from class, the two-stage valuation that we've been using has two stages. The first one is a 5-year super growth period. And so it's assumed that this company is going to grow over the rate of the economy for 5 years. And then we assume that that rate is going to go down. And then after about 5 years, we assume its products mature and it's going to grow at about the rate of the economy. Now, at given current events that we're all experiencing, we believe that the rate of global economic growth is not going to be too great at least for the next year, I don't think. We've all been following the events and what's been happening in the stock market. Anyway, so let's get started. Okay, so let's just write up here. I'm just going to just write up here two-stage valuation. And I don't know, I'm just thinking about these things. So I'm going to put that in bold. It's right there. Okay, so this is going to be a two-stage valuation. The first stage being a 5-year quote-unquote super growth stage. And the next one, starting in year 6, then it's going to go into a sort of a constant slow growth stage, where it grows at the rate of the economy. That would assume no innovation, by the way. Okay, so I'm going to first of all put in some assumptions here. So I'm going to put super growth period, and we'll put in some assumptions here. And we're going to make two assumptions. We're going to make an assumption about the growth rate during this period. Let's write growth rate right there. And we will make an assumption about the cost of capital during this period. And obviously, these are sort of assumed numbers here based on a couple of things I've seen, but just assumed numbers, sort of holding place numbers. And then that's the first stage that we're going to be looking at. The second stage we're going to be looking at is constant growth period. And constant growth meaning that from after year 5 to forever, it's going to grow at about the rate of in this case, slow growing economy, which is, I don't have no doubt that's what's going to happen pretty soon. Okay, so let's say constant growth period. Okay, and I'm just writing, sort of summarizing the assumptions here, sometimes like I do in class, sometimes like I don't do in class. Anyway, the two assumptions I'm going to make for the constant growth period are, once again, the growth rate and the cost of capital for that period of time. So I'm just going to go ahead and copy these things down. Okay, so just to sum here, we're using a two-stage valuation model. One's a super growth period. That's going to go for 5 years. So I'll just sort of say 5 years here. And years. Let's do this. Excuse me. 5 years, okay. And then the growth rate, let's assume a growth rate of 7% for applied materials. I looked at the analyst estimates. I guess it's around that. I would be very surprised if it comes anywhere near that. But we'll see, given international events that are going on now. And this is just, I'm just pulling a number out of my hat, but I'm just assuming an equity cost of capital of 4% here. Now, in real life, you would use the capital Uh, you can either learn about that in your finance class, or if we have the time, I'm not so sure about that. But let's assume 4%. Then we could do it in this class. Sometimes I've done it in this class. Anyway, constant growth period. The constant growth period means that the company's growth period slows dramatically after year 6 from 7%, which is actually pretty good growth. Most companies do not grow at 7%, especially ones that are worth over $1 billion. And it grows. And given world events, let's say that it's going to slow to 1%, which is about the rate of the world economy. And I think the world economy is supposed to grow at 2%. Not, that would be pretty generous now. Let's just say that the cost of capital during this period is 3%. And that seems that seems a little high given everything. But I'm just doing as a placeholder. But whatever numbers you use, the numbers in the constant growth period must be lower than during the super growth period because we're assuming that the company becomes a less risky company and the, the rate of return demanded by investors. Okay, so those are my assumptions now. And here comes the accounting part. The accounting part is really the most important part, okay, and at least for our purposes. And here's what I'm going to do. I'm going to calculate free cash flow. And we use the term in class. And the term in class, if you recall, is the cash flow that's available to the corporation. It's available to the corporation to pay interest and dividends after the corporation has reinvested in plant equipment to meet its future growth needs. Okay, now the calculation I use here is going to be a little different than the one in class, just a little bit different, because I want to be a little more precise about the level of cash flow that we're going to use here. This is the level of cash flow available to both um, shareholders and um, creditors. So to pay dividends, cash available to pay dividends, buy back stock, and pay interest also. Okay, it's going to be a little bit different, and I'll kind of talk about it at the end of all this. Okay, so I'm going to write here free cash flows. There's free cash flows. Okay, and the presentation didn't class, the way we've been doing it now is that we start with net income. And I've done it that way because I want to emphasize that this calculation is kind of a mini statement of cash flows. You start with income, you adjust for working capital, you add back your depreciation, and you take out your acquisitions and your capital expenditures, and you kind of have the asset side of the statement of cash flows, the changes in the assets. But I'm going to just change it slightly here. And as I put the numbers, I'm going to do the labels first, and then I'll put the numbers in and explain why I'm making the changes, small changes that I have. First of all, rather than using net income, I'm going to use operating. And I'll pull that from the income statement in a few minutes. Okay, and then I'm going to take out after that the provision, the tax expense, or as we call it, provision for income taxes. I'll just say provision. Simple. And then everything else will be more or less the same as we have done. So we've got operating income. That's the income that's income before interest and taxes. By the way, take out the taxes, and logically you might have income with interest still in there. Is kind of the idea. Now let's go ahead and finish these three next labels, which are the ones we used in class. The next one is going to be, I'll just say minus change in WC minus change in working capital. And we've done that in class. We'll be pulling that from the statement of cash flows. And then we're going to add back, like we have in class, depreciation. There it is. And then, of course, got to make sure it's a label and not a number. We'll do that. And then we'll take out our capital expenditure. So this would be minus, I'll say CapEx. Okay, and the result of this is going to be a level of free cash flows, which is free cash flows to the firm. This is still a pretty rudimentary. It's not the most accurate calculation. All I care about are the concepts here. And this is the cash flow that's available to pay interest and dividends. This is the cash flow that's produced by the assets of the company to pay interest and dividends after reinvesting in capital expenditures. And that's where we're starting with operating income, because that includes interest, kind of added back the interest expense. And in this case, it doesn't matter because you're going to see that the interest expense is relatively small. Well, it's small, but it's not a big company. Anyway, let's start the calculation. Okay, operating income. First, the place I'm going to get operating income is we're going to go out here to the left to, as you may have guessed, the income statement. Okay, and if you go to cell B12, that is income from operations. Notice that it is before interest expense. So we're starting with income, basically income before interest and taxes. Okay, but it's before interest. Okay, then we're going to take out our provision for income taxes, our income tax expense. And there's a little bit of, we could tweak it even more here, but the concept is that we're starting with income before interest and taxes. Take out your taxes. Because we're looking at a level of income where you want to be able to measure its ability to pay both interest and dividends. That's where we're sort of keeping the interest in it. You could also add the interest back. There's different ways to calculate this thing. Anyway, so let's go ahead and take out the provision for taxes. So this is very kind of rudimentary, I can tell you. And okay, the provision for income taxes is right here, which is 563. Okay, so we'll take out the provision for income taxes. In a sense, that's, in a rough sense, that's sort of your income before interest, but after taxes, you're leaving. We're assuming the taxes is a cash flow basis. We'll leave that assumption aside. Okay, the next three items here all come from the statement of cash flows. That's why we reviewed the statement of cash flows in class. And the first item here is the change in working capital. Now, this is the hardest one to point to, but here we go. Okay, so we're going to hit the equal sign, and the statement of cash flows that I just showed you is about 6 sheets to the right out here. So let's open the parentheses, or let's do this. Let's write sum first here, and open the parentheses. Okay, and let's go over here, way over here to the statement, consolidated statement of cash flows. Here it is. Okay, and here we have the operating section of the statement of cash flows. This is your operating section. Notice they start with the income there. And then you have your depreciation, your deferred income tax. And the numbers we're interested in are in the section that is entitled Changes in Operating Assets and Liabilities. That means changes in current assets, liabilities, changes in working capital. Okay, so what we're going to do is sum, and just take the sum of it. Don't change any signs because the sign changes have already been done for you when you made a statement of cash flows. Just start with accounts receivable of 207 and go down to, it would be, I'm assuming, other liabilities, the way I'm reading this thing. And so it's the sum of B11 through B17. I don't want to point too much because it'll mess it up, but B11, B17, as you can see here. Just hit return. And so the changes in working capital sum to a negative 115, which isn't a great percentage of the operating income. So far, operating income looks fairly big compared to the other numbers, which is what I tried to point out in class. Let's take a look at the depreciation number. Okay, so we're just going to take depreciation as we've always done from the statement of cash flows. Okay, so let's go all the way out here to the right. And I just showed you depreciation. Just go to the operations section of the statement of cash flows, and depreciation is equal to $363 million, I guess. Okay, so we will add that back right there. Okay, and let's compare. And so you're seeing that operating income is substantially larger than depreciation. So take the two, and you're seeing some pretty good cash flow. Depends on their needed level of capital expenditures. Okay, so let's take a look for capital expenditures, we're all going to pull that from the investing section of the statement of cash flow. So let's go over here, and if you go to the investing section of the statement of cash flows, we go down, there it is right there, there it says. It's great because they call it capital expenditures. Can't get a better descriptor. You could put in cash paid for acquisitions. You saw they had some goodwill, but it's such a small number, and I don't want to make this more complicated than it has to be. So I'm just going to use this capital expenditure number, negative 441. Okay, so our free cash flow to the firm, cash flows that are available to pay interest and dividends, should be equal to the sum of these numbers, or at least an estimate of this, is equal to $2 billion, $2.6 billion more or less right there. Okay, and I'm not going to format these numbers, but they're in billions there. I will format numbers as they become bigger and bigger. Okay, notice that the free cash flow to the firm is substantially smaller than operating income. So it's not as small as some of the other companies we've seen. We saw that Apple, their income, net or operating, dominated any capital 10 times as much. And some of their companies, the situation was the same. So this company looks like it can grow on its own, but may need a little financing. We'll see. Okay, so anyway, so that's going to be our base statement, our base year statement of cash flows. Okay, so now we've kind of finished the assumptions, and now we are ready to start the actual valuation. Okay, so we've got two phases here, two stages. One is a super growth stage, which is 5 years. So I'll just write super growth here. Okay, so we'll write super growth, and I'll put in parentheses here. This is for 5 years. That. Okay, and so we're assuming that this the super growth phase will go on for 5 years, and just so that I don't have to keep going back and forth and help you follow this video, I'm obviously not very, I'm not from Hollywood or anything, so we'll have to learn as we go here. I'm going to go ahead and just copy down both the growth rate and the cost of capital so that we can build a table. Our growth rate, I'm just going to go ahead and put the growth rate at 7%. Okay, so now we can go down here. Okay, so our super growth phase, based on free cash flows of 2.6 billion more or less, is going to be 5 years. And the first thing I'm going to do is I'm going to go ahead and label my 4 columns. 4 columns are the period, which is basically the year, obviously. Okay, then I'm going to put in the cash flows. This is before discounting. Make this column here a little bit wider. Okay, then I'm going to put in, I'm just going to put factor, but this is going to be our discount factor. And then finally, make this a little wider here. We'll do present value. I'm going to put PV, present value of what it is worth today. Okay, and I might as well go ahead. Handwriting. Okay. So I'm going to put, it's a 5-year model, but I'm going to put 6 periods in here. Just period 0 is now. I'm just going to use it as a reference. And then 5 more periods, 1, 2, 3, 4, and 5. Okay, now our period 0 cash flow, we know that our period 0 cash flow is that amount right there. Okay, and we're assuming for this phase of the model that the cash flows are going to grow at 7%. So I'm just going to put 7% up here, just to sort of use as a reference. That's text right there. Okay, and that 7% is that right? Is that number right there? And so all we're going to do is start with this number and grow the cash flow. Okay, so here's what we're going to do for year 1. We've done this, and it should be basic Excel work. Okay, we're going to start with the equals. Open the formula, And we're going to make sure that the year one cash flow is 7% greater than the year zero cash flow. Okay, so the year one cash flow is going to be, let's close the parentheses. It's going to be equal to the year zero cash flow, point to that, open parentheses, and just point to cell B20 or wherever on your worksheet 7% ends up, and uh, close parentheses and press return. That number didn't come out because I should have put in, I hope you do too, I forgot to put in 1 plus. So there, that looks pretty good. That's about 7% higher than the initial cash flow of about 2,600. Okay, and we'll format this later to make it look pretty, but at the same time, let's go ahead and do what's important. And what's important now is to make sure, because we're going to copy this down, make sure to freeze the 7% in, because the 7% is going to be what all the cash flows grow by. So you got to put dollar signs in front of both the B and the 20, or whatever your cell is. And in that manner, we can copy down. This is, I'm sure, that's what everybody knows. This is very basic Excel stuff. Okay, so those are cash flows. Now that doesn't seem, after 5 years, it's grown list a little over $1 billion, which doesn't seem like a lot really. So it's a small company to start with, of course. You know, for Rhode Island company, probably pretty large. Okay, but anyway, so it's not looking like the type of growth that some of the other companies we've seen grow at. Anyway, but let's go to the factors now. Let's go ahead and discount these cash flows. Okay, discount factor you should know. It's just the one we've been using in class. It's just the present value 1 basically. Okay, so it's going to be 1 divided by 1 plus whatever our cost of capital is. And our cost of capital here is 4%. So do it like that. And we've got to raise whatever we have in the denominator. We've got to raise that to discount it back for the year. So we've got to raise it to the year. In this case, we're going to raise it to 0. That gives you that number right there. Now, I'm not going to use that particular one here because all you're going to do is get the same cash flow. But there's different ways to do this. But what I'm going to do is I'm going to put dollar signs in front of the B and the 21 there. And so that means that I'll be able to copy this number down to get the correct here. Just a minute. Let's see what we got here. Oh, wait a minute. What am I doing? Okay, sorry. Using up precious time. Let's do it like this. Let's just do it like this. Let's do it. Is equal to 1 divided by 1 plus the cost of capital. And then to raise it to the period, hit the caret sign, and then go to the period. So it's going to raise it in this case to 0. And if you know basic math, it should be equal to 1. That gives you 1. Okay, so this basically is 1 divided by 1 plus B21, which is 0.04, raised to 0. Raise anything to 0, it's equal to 1. But I'm just using this as my base number to copy down from quarter year to year 1, actually. Okay, I'm going to put dollar signs to freeze the B21 in. So unlike the first attempt, we can then get some meaningful discount factors, and those look pretty good right there. Okay, and we're discounting by 4%. Okay, and now let's just multiply the cash flow times the factor to get our cash flows. Don't use time period 0, 1. We're discounting back starting from time period 0, 1. We're trying to compute the cash flow produced by the company's big assets. And so you can almost leave work. Some people actually leave working capital. This here. So our cash flow year 1 times year 1 discount factor. That's our discounted cash flow for year 1. And for the other years, copy down, of course. Correct. Okay, and the cash flows don't look terribly impressive to me. let's go ahead and sum these up, and then we'll label these things out and format. So the total sum of our cash flows for the first, or of our discounted cash flows for the first 5 years is about $14 billion. So this company's assets are going to produce value of 14 billion in the next 5 years. Now let's go ahead and label this correctly, and I'll clean up a little bit here. This is the present value of super growth period. Bold. And I'm going to put this in bold too, because that's the first, that's the value of stage one. We've got two stages. One is super growth. The next one is constant growth. So this is the present value. I'm just going to go ahead just to clean some things up here and make sure that the dollars are at least marked as dollars in this calculation here. So I'll go ahead and format this, format the cells here. Currency or dollars. Hopefully the dollar doesn't sink. When we get to negative interest rates, that'll be an interesting scenario. Okay, and the symbol, the currency symbol is going to be dollar, obviously. 0 decimal places. Okay, do that, and then we'll go ahead and do the same thing here. I know the shortcut key, but I don't know why I like to. So we got about 14 billion here. You know, we're not talking Apple style numbers here. Okay, so this is currency 0. So 14.137 billion is the value of our super growth. Okay, so that's stage one. Okay, I'll go down here. So we've got your free cash flows. So you've got your assumptions here. 7% growth, 4% growth, 1 and 3% growth for the constant growth period. Initial free cash flow of 25.94. When you must make sure to link all the numbers somewhere. You send me a worksheet where you've typed in the numbers. You can might as well forget it. You'll be back at school next semester, which I don't think you want to do. And you know I'm just kidding. Anyway, so let's go ahead. And so that's the initial value for the next 5 years. Now let's look at what will happen when we compute the value of year 6 to forever, as we've done in class. Okay. Like I said, you've done this. This is a good review. But the next step is what we're going to do is create a worksheet on the right, which is going to be much longer, much more controversial in a sense, but it's going to be more accounting oriented. It's going to be based on pro forma financial statements. Okay, so let's go ahead and label this this is the constant growth period from year 5. I'm just going to put 5 on basically 5 to valuing here. Okay, and I'm going to use the same formula that we used in class, and just to make it, just so that you can see what's in the video, I'm learning these little tricks, is I'm going to go ahead and for the constant growth period, just as a reminder, I'm going to go ahead and copy down, so I'm not going back up and down for you. I'm going to copy the growth rate and the cost of capital so you can see the assumptions in the same frame that you can see the calculations. Okay, so there's our constant growth period. And then from up on top, the growth rate is 1%, and the cost of capital is 3%. We'll discuss why I chose those numbers in a second. I mean, in reality, these numbers are getting so low. We're in different times, folks. We're in times of negative interest rates, things that, you know, a few years ago, textbooks didn't even talk about. We're in different times. Okay, so we're going to use the constant Gordon growth model, I guess it's called. As you recall from class, there's a numerator. So I'll just put numerator here, numerator. And there's a denominator. Okay, and I'm just going to label these. If you'll recall, the numerator is equal to year t plus 1. So in this case, that would be year 6, year 5 plus 1. And that'll give you, if you use year 5 plus 1, when you do all the math for this, and it really isn't that hard, you will get the value at the end of year 5. That's just the way the math works out. The denominator is really the cost of capital minus the growth rate. Right in front of you. Okay, the numerator here is going to be the cash flow at year t plus 1, which is just the cash flow at year 5, which we have right there. The cash flow at year 5 uh, with growing at 3%. So it's just, we're just going to take the year 5 cash flow, and since starting year 6, this company starts growing at 3%, we're just going to multiply that times 1 plus the growth rate. What am I saying? 3%, 1%. It's so low, it's unbelievable even to me, but we're going to take 1%. So the year 6 cash flow is just the year 5 times 1.01, because this is going to grow at 1%. I keep thinking that 3% is the growth rate. These numbers are becoming so low, even in reality, it's almost unbelievable. Okay, so our year 6 cash flow is the year 5 cash flow. Look how small that growth is, times 1%. Okay, our denominator, according to the formula, is going to be the cost of capital minus the growth rate, which is going to be 2%, should be 0.02. Okay, so that's our numerator and denominator. Now, according to the math of this formula, if we take this numerator, the year 6 cash flow, and divide by that denominator, that will give us the value of terminal stage at year 5. Like I said, we've done this in class, but this is good, not just to review, because we're going to actually take this and use it at the bottom of the larger calculation. So value of terminal stage at year 5. Okay, and so I'm going to put it, I guess that's a good column because it's wide. I'll put it right here. Okay, I'll put it right here. Okay, so the value of the terminal stage at the end of year 5 is going to be 3674 divided by 2%, and that's going to give me a rather large number there, or else I don't know how large that number is, but it gives me 183 billion. For Apple, that would be like somebody's daily paycheck or something like that. 183 million is what I should say. And for Apple, that would be probably their petty cash. And so that's the value of the terminal stage at year 5. Okay, which is not, it's relevant, but we have to, since that's the value of the terminal stage at year 5, like we've done in class, we have to take that and actually discount it back 5 years to get the value of the terminal stage now, present value of the terminal stage. So what I'm going to do, and try to be very transparent about this, is I'm going to take the 5-year, this is the 5-year discount factor. The 5-year discount factor is just this number equal to just that number right there. That's the number you would discount back 5 years. Okay, so if we take the value at year 5, discount it back 5 years, that will give us the present value, PV, present value of terminal. And so, and I'm going to put that over here. So I'm going to add up both stage 1 and this stage right here. So the present value of the terminal period is 183 million times, because this is a factor, 0.82, etc. So that will give us probably some decimals in there. Yeah, there it is. 151 million, which makes sense. And so we've got two values. I'll put it in bold that we're going to use to come up with the value of our assets, basically. The present value of the super growth period and the present value of the terminal period. And I'm going to go ahead and, like a good accountant, I'm going to underline that second number there. Make sure we get both numbers in here. Okay, so I'll say value of firm. And you could say, I'll say value of firm here. We're going to consider liabilities, assuming everything turns out. Weeks maybe. Okay, so we're saying that this firm will produce 14 billion over the next 5 years, or the present value of the cash flows that it produces over the next 5 years, 14 billion. Then from beginning year 6 to forever, 151 billion. So the total value of the firm is the super growth present value plus the present value of the terminal period, and that's going to equal $165 billion, 24 cents more or less. I'm not going to make it pretty because it turns out it's close enough. Okay, so all we've got to do is divide by the number of shares and make sure to link everything. If you send me a worksheet, you haven't linked it, well, I'm going to send it right back. Okay, so number of shares, the easiest, like we've been doing in class, is just take the shares that are in the earnings per share calculation in the income statement, which happen to be, over to the income statement, basic shares, I guess that's 937 million. So we're going to take 165 million, it's in millions, 165,000, but it's in millions, divided by 937 million shares. And we'll just say value per share. We can almost put a question mark there, but the number is not unreasonable. And so if we take the value of the firm, or you could say value of equity if you want, we're going to tweak that as we go along here, divide by the number of shares, we get a value of $176.25. Now, if you compare that, this is Friday the 13th, just what a day. Friday the 13th, but this is about 11:30 at night on Friday the 13th, and it's $176. Take a look at what the share is trading at now. And of course, you can take this model with a grain of salt, but we also know that the markets have sunk due to the pandemic and all that. So do we have a buying opportunity here? I'm not sure. I would hesitate to say that we have a buying opportunity, given that the factors which are driving the stock market down we don't know what's going to happen. There's a lot of uncertainty, but the stock has been driven down. If the world economy comes back and this company comes back along with it, or if its markets come back, maybe you could pick up something here. I would rather consider it to be a buying opportunity, though, than speculation. Okay, so that's our first lecture, and I will send you the other lectures. I'll post the other lectures as I make them, and you will see them. Good night, good day, whatever, and good bowling. Thank you. Bye.